Good morning. So this panel on quantitative trading, as Tanya said, we'd like it to be very interactive. So if you have questions during the conversation, just raise your hand and I'll get to you. So we'll be asking questions throughout. My name's Monique Miller. I work at Wilshire Associates, and Wilshire, many people know of the firm as a very large consulting firm, both for private and public pension plans, endowments, foundations. I work on a different side of Wilshire. I'm in the funds management group. And we are really the asset management arm of Wilshire. We advise on about $150 billion, largely for financial intermediaries. And I run business strategy for alternative investments. My history is I spent about 10 years at a large hedge fund in New York, Caxton. I work with Tanya there, and also in a prior role at a risk management consulting firm. We started off in risk at Caxton and then basically grew a quantitative trading group from scratch. So I led that quantitative trading group looking at early stage quant managers, early stage strategies, evaluating them, funding them, sometimes defunding them. So very, very interesting role. My panelists, I'll let you introduce yourself. Katie Kaminski.
Katie Kaminski. I am from Campbell and Company. Campbell and Company is actually, interesting enough, the longest continuously traded hedge fund in the United States. The firm was established in 1972. We trade in futures. So we develop systematic trading strategies to trade the futures markets across all asset classes. I'm a director in the investment strategies, a director of investment strategies. So our group's function is to build trading models, test them, implement them, and also build risk systems to monitor and automate all of the systematic strategies that we build. It's an exciting job for me. I spent some time originally as an academic. I did my doctoral degree at MIT and then moved to working at the Stockholm School of Economics. So I've been both an academic and I've been an allocator as well for a CTA fund of funds. And this is what led me to go to work on the front lines of a hedge fund. I recently wrote a book on trend following on this particular topic. And now I'm just excited to be here to talk to all of you about quant strategies.
Lisa?
My name is Lisa Borland. I work at a company based here in LA, even though I live in San Francisco, called T2AM, which is a company that invests in quantitative trading strategies. Prior to T2AM, my background is theoretical physics, so I have a doctorate, which I completed in Germany, and then moved to the United States to do academic research, moved to Brazil for academic research, and realized that all of the models and theories I was working on in physics had a much better application in finance, interestingly enough. So I was very interested in moving into finance and started at a hedge fund in San Francisco in 1999 called Evelyn and Associates, and I spent 10 years there. So kind of the opposite of you, from having gone from allocating to hedge fund. I was in the trenches at the hedge fund developing and trading strategies in statistical arbitrage. I did a lot of work on options and derivatives and future strategies, and then I went to work at a startup in Silicon Valley trading high-frequency foreign exchange. And along this path, I managed to maintain a parallel academic career of publishing papers in physics and finance journals, and I'm a lecturer at Stanford University, teaching currently a course called Big Financial Data and Algorithmic Trading.
Very popular.
So I'm still doing that and working now in this role at T2AM, where my official title is Head of Research and Co-Portfolio Manager.
So this is a rock star quant trading panel, to say the least. Okay, so you guys have some comments first or questions, and then we'll open it up to the group.
Sure. So I'll start us off, and I think it'd be interesting to talk a little bit about the evolution of the industry. because it's changing and it's changing rapidly. And so, Lisa, why don't you kind of talk a little bit about your experience and what you've seen?
Sure. So, first I want to kind of define what, at least I think, we mean by quantitative trading to set the stage there. And that's not a trading strategy. It's an implementation style, a systematic implementation style of a trading strategy. So there are basically two things which have happened over the past 20 years that have kind of caused big changes and evolution in and facilitating that one could implement trading strategies systematically. So the first one is electronization. And I think back in the 80s, and the company that I worked at in San Francisco when I got there, we had these dot lines to the New York Stock Exchange. And so, you could send your orders electronically to the New York Stock Exchange, but they were executed manually once there. So in those days, you had the New York Stock Exchange and NASDAQ pretty much. Most of the flow was institutional flow. And, trades were larger than 1,000 shares was a typical trade size. And speed was not at all important. And then in the 90s, it became popular to do these kind of basket trades where people would be entering large trades, entered via a computer and sent to the stock exchange. So that's, the first step. In the old days, it was someone calling up on the phone, and now you have orders going into the computer and down to the stock exchange.
The old days being the 70s and the early 80s.
Right. And then, so let's see. Now then, a big thing happened in the equity markets is that in the old days, the spread between the bid and the ask could be about 6 cents or 1/16. And then around 1999 or around 2000, 2001, I think, yes, decimalization was introduced, which meant that that spread could go down to a penny. So as you can imagine, that changed the entire microstructure of the markets, because in the old days, you had market makers happily making those 6 cents on buying and selling, and suddenly that was not profitable. So the human market maker kind of got replaced by automatic market makers who could, because then more people could electronically try to compete on that 1 cent. So that was a big change and attracted more sources of liquidity into the market. Then in 2005, Reg NMS, this is they introduced 3 rules to regulate the national market system. And one of them was that if you want to execute a trade and if somebody has a better price somewhere from all these different fragmented liquidity sources, it has to be executed there first. So what this meant is that, many, many more people could suddenly try to compete for liquidity by, trying to play a game of putting in a best price. And it didn't really matter how good quality these things were, but they all evolved. So suddenly now, and that's kind of where the path we've gone until today. So right now, we have about 13 electronic exchanges. We have about 40 dark pools. And the typical order size is less than 250 shares. So the volume is largely dominated by high-frequency traders. And if you now look over those 20 years now, we've gone from institutional flow, New York Stock Exchange, speed doesn't matter, to this fragmented marketplace where information is coming in at a rapid pace, and speed does matter, and it's very competitive. So given that evolution in the electronization, at the same time came an evolution in the amount of data that was available, right? So back in the old days, if you were lucky, you had monthly data or daily data on prices. Nowadays, there is like a terabyte of information produced every day. Largely also because, not only every tick, every quote, every order, but because of hiccups like the flash crash or other things which have happened, the regulators have tried to control the markets more, so people have to output more information as a kind of paper trail. So there's a ton of information. Okay, so given that information, that's the second step, people were able to start analyzing that. So remember we said that a quant strategy is a systematic implementation. So traditionally, a discretionary trader may put on a few good trades, right? That's what he can manage. But if you have access to all this data, you can analyze it and find, subtle statistical relationships which were not obvious, before. And so a quantitative trading strategy may have 1 million of trades with just a 52% edge. So it's gone from a few certain trades to a large number of low probability but still above average winning trades. And so in my opinion, that's kind of been a parallel evolution from just electronization and data access and capture, and then along with it the research and the types of strategies that can come out of that.
And one interesting comment about that is, as you see these changes in the market structure, the types of strategies, systematic strategies or approaches that used to work, don't always work because the fundamental market structure is changing. And, one example of that is decimalization, right? I remember back in 2001 looking at statistical arbitrage strategies, right, where systematic strategies that would buy certain stocks, sell certain stocks, stay relatively balanced. But all of a sudden, things were trading at pennies, right? So those strategies that would rely on a bigger bid-ask spread just stopped working, just literally stopped working. So the thing to keep in mind is kind of, data's changing, market structure's changing, different market participants. What worked in the past doesn't necessarily work in the future. Katie, you want to tell us a little bit about the futures market and
maybe
the evolution
I can talk.
there?
I think it's good. Maybe I can talk a little bit about what systematic trend followers do, because when we talk about HFT, we always feel like dinosaurs in some sense because we move very slowly compared to that. So that's a good thing to kind of explain how we handle that situation. We trade much more medium to longer term. So we have models, and here's how we've had to catch up. This is kind of give an example. So our models are a lot slower. So they're looking at time horizons which are much longer. So medium term is about 3 months. Long term is 6+ months. So we're building models that are looking at long-term to medium-term trends across different futures markets. But one of the things that we've had to do in our industry is evolve more and more in the technology side to be able to handle some of these issues in terms of execution. So we have extensive groups and substantial research working on execution, cost estimation, sampling the market over the day, trading in an effective way to get towards a target allocation. Whereas in the olden days, we kind of took a longer term model, and every day most CTAs would look at those models and then just implement the trades, and then the next day do the same thing and then implement the trades. And what we've had to do is really sort of expand on this shorter term horizon to be able to properly execute in this environment. So that means that it affects a lot of some of the sort of how we get in and out of the market and some of the competition there. But on the positive side, you were talking about futurization. Given what's happened in the regulatory environment, post-EMIR, post-Dodd-Frank, there is a huge push for futurization. So what I mean by that is that there's a tremendous push towards having more and more contracts that are standardized, cleared, and exchange traded. The numbers are actually was shocking to me when I did a little research on this, that prior to 2008, a lot of the volume was really OTC. And what we're seeing now is more and more of these contracts are coming into the limelight, in that people are watching what they're doing and they're being standardized. So for us as quant traders, this is very exciting because we play the numbers, just like the shorter term guys, that the more things we can trade, the more things that we can test our ideas on, the more opportunities that we might be able to find at many different frequencies, both slow, but even on the faster side. But fast for us is maybe 1 to 3 days. So that's really fast for us. Yeah. So yeah, it's good to distinguish between.
Okay. Any questions before we move on kind of evolution, history, where we've been? Okay.
Oh, you got a couple.
Oh,
You got
okay.
a couple.
Okay, over here on the right.
Hi, I wanted to ask
Could you just wait for the microphone so the live streamers can hear what you're asking?
Thank you. Excuse me. I wanted to ask, since you've seen the changes in trading strategy, have you seen trading costs change through time, and especially in a high frequency kind of environment? How does that fall into determining how strategies are made?
Okay, interesting. So obviously, trading costs can be defined in various ways. So you could talk about the spread, which has obviously gone down. You can talk about market impact, and you can also talk about actually the cost of being able to trade. So the infrastructure enabling high frequency trading, that is expensive, because this is a game where speed matters. So people invested a lot of money in getting the fastest optic lines or the fastest microwave connections in order to play like a kind of arms race arbitrage game. On the other hand, in all fairness, at the same time, the cost has gone down because it also used to be more expensive for people to people tend to put their computers co-located next to the exchanges to minimize the distance. That used to be expensive, and because that's become cheaper now. So certain costs are going down. It's becoming a little bit fairer and more competitive for the everyman to have access to decent speed, decent latency. And also many brokers are now providing high frequency trading algorithms which they can access. So in a way, I would say the infrastructure for like really playing this kind of speed arbitrage is very expensive, and so to trade that is expensive. But to approach, it's the cost and the access for people, general traders, to approach like a low latency is going down.
And I think that that's a great question, because things like trading costs are not to be ignored, right? And with high frequency trading, although commissions have come down over the years, and as we talked about, spreads have come down, but if you're doing lots and lots of trades, it can certainly erode returns. So great question. Maybe one more if we have one.
There was
before
one in the
we
back. Yeah.
Yeah, I was wondering if you could touch a little bit on how...
Could you wait for a minute for the microphone? Sorry. There you go.
I was hoping that you could touch a little bit on how the technological shift has maybe changed the peripherals of your business in terms of what kinds of clients are interested in your business now that weren't previously, and vice versa, and how has that changed sort of the scope of the firms that you work at?
Do you want to take a stab at that?
I can take that one, and then you may also have some comments. I would say that quant has become more and more, people are accepting more and more the importance of using systematic approaches to deal with the tremendous amount of data. I'd say that the real advantage that all of us have here is that we need to communicate that. So that's the real challenge, is the education and sort of being able to help investors understand how quant works. So we're definitely seeing lots of opportunities, and quant is going to be a lot of the investment future. So the traditional way you were talking about, more sort of, or I think it was Tanya, we're talking about more sort of taking a couple bets.
Well, that was me, yeah.
Yeah, that is sort of going away, whereas we're trying to build risk premium portfolios or invest in things. And the only way to do that in a very sort of effective way is to really have a systematic approach to do it when we're handling a lot of data. So I'd say all of this is good for the quant space, but it gives us a good challenge, because we're really going to have to be able to explain to everybody who's not quant, how does this work? I mean,
and be able to work in teams, because the scale of these problems and the challenge is so large that you cannot work on your own. So becoming a really good team member is a critical part of success, I think, in these financial mathematics positions that are here today, because you can't do it alone. You need to be working with people who can lift and clean data. You need to work with the technology side. They're critical partners to any success. You need to be able to work really with the the theoretical side who have great and terrific ideas that they're testing. And then the implementation piece, as you're hearing, is constantly changing in terms of how the executions are working, what's going on with the costs, where you're getting your information. And so that part needs to be well integrated as well. So this is a huge team operation, which is exciting because, you know, unlike I think what the vision was of many quant positions early in what we're calling the dark ages of the 70s and the 80s here, quants often worked behind a door with the problem being slid under the door. And that is really no longer the case. So you need to be able to communicate, collaborate, work in a team, be very sensitive to the piece that all the different participants are bringing to the success.
I also want to point out one thing, which I think is an important distinction here. So, you know, we have the systematic trading strategy, and then we have algorithmic execution, okay? And so when you were mentioning that those bets, even for discretionary traders, your question about technology, even if you have a discretionary trading strategy or, you know, just updating your portfolio once a month, so your buy and sell decisions are, you know, discretionary or systematic. There's a second piece, which is, you know, the execution in the market, and I think that that piece affects everybody because it's all happening electronically now.
Absolutely is. So that's a great transition because I wanted to talk about the types of quantitative trading algorithms. And, you know, what's the commonality? How are they different? To just kind of give an overview of the space.
Okay, so, all right, so first of all, you know, I'll take a stab at that because Katie is an expert on the trend following and future CTA space. So maybe I can give a briefer overview on the other spaces. So in almost every asset class that you can trade, people are trading systematic trading strategies. In the foreign exchange markets, which, by the way, are still kind of immature relative to the equity markets because the execution there is over the counter. There is no real centralized electronic like order book or ECN. In the equity space, there are some standard kind of classic strategies that people know about. And in the derivatives and options space, there are also some standard classic strategies that people know about. And so when I say standard things that people know about, what I mean is that one class of strategies, for example, statistical arbitrage, is a strategy that tries to bet on two instruments that are similar. Okay, this can be two stocks that are similar, or it can be a stock versus a basket of other stocks that are similar, or versus an ETF. And you try to, because they're similar, if they diverge at any point, you kind of make the bet that they will converge again, because overall they're going to move together in tandems. So they'll have some idiosyncratic deviations from where the commonality is, and then they'll, you know, revert to that. So these types of relative value strategies or mean reverting strategies are common in all of the spaces as long as you can find you know, a good reason for why the instruments should move together. So I think that kind of captures a large set of quant strategies without going into detail. And then in the options space, in the derivative space, there are also, now the derivative space I think is very exciting because it's a little bit more difficult mathematically to model, so people are afraid of it. And the people who trade it most successfully are often discretionary traders who really have just a feel for it. So if you as a mathematician can come in and model that slightly more complicated space in a good way, it's possible for you to again find systematic things, you know, like in the stat arb strategy, things that should be, you know, reverting or converging to something. And on the directional side?
Yeah, I think that we do lots of different things, both exactly like you said on the directional, but also we do the relative value stuff as well. So I can give a couple examples of the type of strategies in the CTA space that we trade and how the idea is. So in general, within the firm that I work at, but also many other firms, most of what we trade comes from an investment thesis. So we have a thesis that there exists some opportunity in a market based on some economic or some sort of relationship that we believe in. Then what we'll have to do is test that thesis and then develop a robust, systematic implementation of that thesis. So let's take trend following as an example. Trend following is basically just trying to predict momentum or movement in different markets. So we're going to build a model based on different time horizons to measure the trend in the market, up or down. Then we'll modulate that position as a function of the strength of our measurement of that trend. So in order to do this properly, you may find trend in one market, but you actually have to measure trends across all markets, aggregate those signals, combine them based on their correlation and the properties of your model to allocate different risk to different markets. So it's really a systematic process of directional. So you're trying to measure the direction and you're going to trade that in a basket across all markets. But we also trade things like carry, for example. So carry trading is a good complement to trend following because carry is based on the investment thesis that you can carry an asset forward across the futures term structure and earn that carry on that asset. So for example, covered interest parity, you have different interest rates between different countries. So you can sometimes earn the differential between those if the world doesn't change. So that type of strategy works really well if the world doesn't do anything, whereas the other strategy is going to do great when the world is moving. So last year, trend following kicked it out of the park. But in other years, you might find that carry trading will go really well because the world didn't move. Okay, so you're carrying forward and earning that premium across the future spread. Two other examples, mean reversion. So this goes back to, so we also trade mean reversion as an example. So mean reversion is shorter term strategy where we're looking to measure the idea that, especially let's say within a sector, that markets within a certain relationship with each other may revert to the average of what's going on in that sector. So what we'll do is try and create a systematic measurement of the strength of mean reversion and then allocate the positions as a function of that strength. So what we'll do, that's an algorithm level, we'll have these different algorithms, but then we also have to combine them. So that's sort of the fun part from the portfolio management perspective, is taking each of these different models, their convictions, putting them together, and then trading them as an aggregate strategy. There's a lot, I mean, you can do it separately or together.
Right.
But
So just along those lines, so how do you know if the world's going to change or not?
I guess you don't.
And how much risk do you put in each one of those sub-strategies? Because from my perspective, that's a big piece of, that's a hard part, right?
So one thing which I personally am interested in research-wise is exactly kind of related to what you just said, and that is, you know, if you could somehow measure signatures of the environment, and if you were able to predict those, and if you could find that, you know, systematically, which people have done and we've done, and I think you've also done, you can kind of tell in general when, you know, in retrospect, when certain classes of strategies will work or not work given the environment. So if you could measure the environment and it were predictable, that would help you a lot in being able to know which type of, you know, at least strategy class or asset class to invest in. And that's obviously, you know, a very, very hard thing to do, and not sure if it's entirely possible. In my own research, I've seen hints that in certain cases it is possible, but that's really the gold question. Of course, if we all knew what's going to work tomorrow, you know.
So I can add on to that one point, is that we actually tend to be very conservative on the predicting part in the sense of which strategy works better. So this is the philosophy, in each different firm and each different system works differently, but we tend to be more, let's have lots of different approaches and then let's just one over end those approaches. So we tend to be more sort of, if any of you are familiar with the literature about the one over n diversification heuristic, we tend to focus on that, but we have lots and lots of different systematic approaches in a bucket.
Right, no, we do too. We don't predict. It's almost impossible.
It's
I'm
hard.
just saying it would be nice.
And
It would be lovely.
Again, Katie's at the longest standing firm in this area since the 70s. Okay, so it is really hard to do this over extended periods. And maybe, Monique, because you spend so much time with different funds as they're starting, right? I mean, I see dozens every week, frankly, of ideas. What makes a fund successful at the launch? And also, you might speak a little bit about the lifespan of funds and how long the traders actually successfully sit in the chair, just to really contrast how short-lived it can be and why.
Oh, it can absolutely be short-lived. The one thing that I think about when I go and talk to an emerging manager or somebody, even an established manager who has a new strategy is, all right, what can go wrong? Like, what's my risk? And a lot of times people have great, well-diversified strategies, right? Different strategies, trading different instruments and all that. But something happens in the world and it turns into one big trade, right? And your exposure is much higher than you ever thought it would be. So for me, when I look at managers and strategies, one of the biggest concerns is what's the risk control? What happens in the systematic strategy if it starts going away from you? Start losing money. How are you measuring risk? How are you measuring correlations? What happens during certain drawdowns? And what is your process for following those rules is really important. And, I'll also mention one of the facts I alluded to before. I always used to say quantitative strategies work until they don't work anymore. And they almost always don't work anymore. And a firm like Campbell, I'm sure what they're doing today is very different than what they were doing 30 years ago. And I'll let you speak to that.
I can speak to that if you
And,
want.
and it's not just because there's a lot of people trying to do the same thing, which there is, but the markets have changed. So why don't you?
I'll give an example of that. So I obviously the firm that I work at now is older than myself, which is an interesting situation to be in because, you don't know all the people that were there when it formed. But originally, a lot of the systematic CTA traders really were using pen and paper and doing a couple back of the envelope calculations and measuring the trend. Okay? And back then something was called turtle trading. So you had the turtles that used these rules and they followed their rules and made a ton of money. So if anyone's been in Boston, for example, John Henry was a turtle trader. He bought the stadium. There's a lot of very successful turtles traders.
Yeah.
And then eventually this turned into using a computer. Right, and using the computer and the calculator to make these trends. And then even up until 2007, 2008, the strategies were still sort of basic. We haven't changed our strategies much, but we've added new strategies and we've gotten faster and we've had to pay a lot of attention to these issues here. So infrastructure is very important for us. But our industry did start literally with pieces of paper.
And slide rules were common instruments on the trading floor when I started. There were no screens and computers. So that is how much the world has evolved. And I will go out on a limb here and say in 10 years, in 20 years, you won't recognize it from today. The things that you're learning will be just as archaic to the things that we started out with. And so one of the things that's critically important, and I do think sets apart the firms that survive versus go out of business, are the firms that stay on top of the new developments and advances. Your personal network will be wildly important to you to stay on top of what's going on and to stay abreast of it. And as soon as you stop staying abreast of it, then your firm will be one of the ones that bites the dust and you'll be looking to move into a new one. So as you actually go out and talk to firms, for those of you going in this area, it's pretty interesting in your conversation to discuss with them how they do that. How do you guys stay abreast of what's going on in all these different dimensions. It's not just theoretical, it's also the execution, and it's also what's going on with, the development of new markets and also where funds are moving. The whole ETF business that we'll talk about later today did not exist 20 years ago, 15 years ago, right? You wherever you want to draw your line, it's really changed.
And I just want to add one thing to the risk conversation that we had. I think that, when you're doing a quantitative strategy, it's very important, as Monique mentioned, what they're doing when things go wrong. But risk is really inherent in every single level, from cleaning your data. Garbage in, garbage out. That's the riskiest thing you can ever do, is not really pay attention, especially in a quant space, to timestamps, to the order of the data, to bad quotes, etc. So clean data set, eliminate that risk. And then also, overfitting and modeling risk. There's only one history, and so you can tend to think, oh, I'm going to be a millionaire tomorrow, like I fit these 100 parameters here and look at my upward sloping line, and then you go live and it just all goes downward sloping. So
because you realize that you're in and out of sample, we're one big sample.
Exactly, right. So, that again is really why I think it's important to understand, as you mentioned, have a premise, like an intuition as to why is this working, why should it work, and to have a robust model with few parameters, and also to understand the environment when this should work, because that will also help you understand any unwanted bets that you may have. Like, for example, I recently did an analysis for, there's lots of these up and coming startups, we'll talk about those later, where people, anybody can just write an algo. And so they gave me a bunch of their data to analyze, and I did an analysis comparing their algos with our traditional hedge fund manager algos. And their algos all had Sharpe ratios of 2, were making money like this, and they all just were long only, long beta, of course. The market's been going up for the past 2 years, right? So, I think initially if you're a novice or starting at this, you don't think about that. Like, you think you're doing this, but you're just betting on the market. And so the final thing I wanted to say on this is that the market, the S&P 500, if you do like a principal components analysis, there are literally 5 main factors that describe that. So to your point, you have all these different strategies, and then suddenly, something happens, and it's just that all those 5 principal components collapse to one, and it's just the market bet you're doing. So one way of hedging risk is to make as many uncorrelated bets as possible, and to make bets based on the idiosyncrasies, outside of those 5 factors. So diversification.
I can give an example of that. Last month, April, there was a very large move in the US dollar. And the US dollar move created a precipitous move in lots of other markets, which you could have had positions in at the same time. So that's an example of that, where you think you're very diversified, but the dollar is running the show. So if that happens, it can actually affect everything that you're doing, because that thesis, the dollar thesis, what's going on with the dollar, can dominate whatever your other theses are. So this is why it's a lot of work to test.
And make sure you're uncorrelated. Let me see if there's any questions at this point before we move
And it
on.
doesn't just have to be on the topics they're talking about, anything related to quant, because we have about 15 minutes before we move, and we could frankly do every one of these panels for an entire day.
I know.
So this is your 15 minutes left sort of on the quant trading, so.
Yes?
Just on your question on, finding undiversified bets, like, it's still backward looking, isn't it? Like, things that were uncorrelated even 2 years ago or a year ago suddenly becomes correlated. So how do you, and the idiosyncrasies that you're talking about, it's not large enough, or you might not be able to find enough bets to make large, trades on those things. So how do you guys deal with that?
No, I mean, that's you have a very valid point, and that's what is very, very hard. And that is why, like when you're making a model, whatever historical relationship was there, it may not hold tomorrow. And that's why it's really important to have at least a kind of intuition or an investment premise as to why that relationship should hold in the long run. If you're only looking at the data, it's very, very dangerous. So, one tries to build one's trading strategy ideally around something that just economically or intuitively should make sense and should hold going forward, because that's the real thing tying the correlation, right? For example, that stocks in a certain industry, should all be driven by similar factors. And so if they look highly correlated now and then they look less correlated tomorrow, chances are they will, that'll fluctuate. But there's not much more you can do.
Yeah,
Go
go
ahead.
please, no.
I was just going to give an example of that. I mean, so you have to start with an investment thesis. You have to try ways to test it. And sometimes you have to maybe take it on one market and then trade it on another market, do something with the data. You can do the best that you possibly can. But I mean, I use trend following as an example. But imagine you take that strategy and you optimize it to find the frequency of the trend that was the best in the last 2 years. You can find that, and the Sharpe ratio will be huge.
I
right?
call that the gold point. Like you've optimized to the one shiny gold
The
dot.
shiny gold dot. And so you can find that. And but what you have to do is be able to say, we believe in the premise of the idea, and let's just implement it across lots of different ways, and try and just have a robust, as opposed to try to fit the optimal trading strategy, because the optimal is always worse out of sample.
I do want to add one thing there, and I've seen in my experience there's two ends of the spectrum: simple and robust and very broadly modeled, or super fast and super overfit. Because sometimes in the very high frequency space you can find short-lived correlations which change all the time, but they're there for a little bit. They're fleeting there. So like this whole machine learning, we haven't really gotten into that. Fast machine learning techniques seem to work also. So, but you have to be aware of what you're doing and why it will work.
Yeah, and I would just add too, taking it from looking at asset classes to looking at strategies. So if you look at various asset classes, stocks, bonds, commodities, currencies, they can be correlated over time. Even stocks and bonds, if you look back in the history, they're hugely correlated through long periods of history. But when you take it to trading strategies, right? So I'm going to buy this at one point and I'm going to sell it at another point. And now you have a strategy that does something based on some factor, perhaps momentum or value or whatever it is, right? Mean revert, whatever it is. And once you have a strategy across various asset classes, they tend to be less correlated because they're active. It's not just passive investing in a...
I did a study.
Uh-oh.
Very interesting. I found, again, in conjunction with my having access to like lots of hedge fund strategies which are not public. I mean, we have them, and then that company that gave me theirs. I did a cluster analysis looking along through in all these strategies. I found maybe 3 distinct groups. So even though people think they're doing something different, right?
That's a great point.
Even though they think they're doing something different, they all fell in like their own cluster. Like the trend following guys were all here.
Oh yeah.
Relative value all here.
What period of time was that study? What years?
From 2003 to current.
Yeah.
So I was really surprised about that. And there's obvious deviation, but
Right.
it's not as diversified as we may think.
I agree with you, and it's not easy, right? So thinking about the strategies that are complementary and thinking about how that changes over time, because going back to that other point, the world does change, right? So I think it's a great question and a hard problem. So we only have about 10 minutes left, and I think it would be great to get the panel's perspective on kind of the future, where we're going. We've talked about the past. Lisa, do you want to start us off?
Sure. So first of all, I teach a course at Stanford, and I'm really lucky to have students in the class because everyone wants to go and create their own startup, especially in Palo Alto. So the future is that it's going to be much more competitive. As somebody mentioned in the beginning, it's going to be more competitive to get good people to go into mathematical finance and trading because it's not as hot as getting venture capital funding for your thing. That said, I think that there's a big trend now to kind of like, de-Wall Streetifying data and access to creating algorithms. So there's, a few companies, open source places where you can get access to really great data that in the past used to only be, people in big companies could have access to it. So you and I, everybody can get access to more data, and there are more new kinds of data coming up, as we said. Not only the social media type of big data, which is valuable until it's not, because the signal to noise ratio is very high in that data. So it might be possible to really create some informational new strategies from those, but that's
The
something
filters
for
are
the
yet
future.
to be determined.
Filters are yet to be determined. But then also just that the crowd, there's this website called Estimize, where instead of earnings analysts on Wall Street, evaluating a firm, everybody can on Estimize, and so it's like a crowdsourced evaluation, a different source of information. Whether it's good or bad, I don't know, but it's different, and so there are new data sources sprouting up. And then also, I think I mentioned before, there are a couple of companies like Quantopian and Quant Connect and some others where you can create a login and immediately start programming an algorithm in Python, access their data, backtest it, and go to market. So the barriers to entry into this space are going down. So that's what I think. It's becoming more accessible overall.
What do you think, Katie?
I think, I think my background is more sort of thinking of it from the investor side, and I would say that what we're seeing just on the more quant trading strategy side, that this area is becoming more and more sort of something that is a standard that people are learning about, and learning about how to understand what important issues are important for doing due diligence, and how to invest in quantitative strategies and quant trading. So I think that's another area to think about, that you can use your skills, both communication, but also in terms of trying to translate that to things that are usable for the investor.
Yeah, and we see even on the discretionary side, discretionary traders are more and more relying on kind of quant data behind that, to kind of make their views and do their trades. And I think from the investor's perspective too, they're always asking about process and is it repeatable, and using systematic strategies to maybe enhance their entire portfolios based on factor-based models or factor-based risks, or getting certain exposures that they want in the short term, and doing this kind of relatively inexpensively and efficiently. Tanya, I'd be interested in your thoughts about the future of quantitative trading.
Well, even though it took a little bit of a tumble, largely through black box techniques, I think, where people had outcomes they didn't expect because they perhaps did not have the intuition that this panel's been when putting a big stake down, saying that it's not just studying the data, that far beyond that, you have to have a good intuition about why that strategy seems to make good sense. You could study the price of oil a couple of years ago and you're out of sample, and you could be looking for a very different move than we're likely to have in here in oil. So I think that it's important to sort of look back on what didn't work, but when you talk about what will work, I guarantee that this will be a lively area of finance. I think it's a growing area of finance. For those of you starting careers, I heavily recommend going into a growing area, not an area that's contracting, because it means that lots of people will give you a hand up and you'll get promotions and you'll get more responsibility. I think this is certainly one of those areas. It's why we kind of decided today to showcase it, and I just think that one of the things we might just do for 1 second is talk about the many different aspects. So you can design a trading strategy. You can be a person who sits next to someone who has a vision for a trading strategy. You can be a person who tries to wrap the programming around what a brilliant trader who's more sort of older school, who has a lot of really good tuition, really good chops, really good track record. How do I take what that person is doing and apply it maybe to many other markets? So there's some interesting opportunities there. I think rolling out what we've learned to work in the trend following and on the future side of the business into new types of structures. There's a lot going on in ETFs, working as a quant to help the dealer community to implement strategies there. And I do not want to under-advertise the positions that are in the data side and in the technology side, because they are joined at the hip to the success of these quant trading strategies. So if you aren't a person who's going to be the lifter of the data and the cleaner of the data and the filter of the data and the owner of the data, you need to embrace and love the people who are doing that for you, because you will not be successful. You will have garbage in and garbage out.
And the people who do that at some of the most successful firms have PhDs in like physics. I mean, it's non-trivial.
Right, and they're fascinating roles. I mean, the nice thing about this role is what all of us do today in these positions is not what we will be doing in T+1 year or T+5 or T+10 and T-1, 5, and 10. It was a completely different business. So I think the nice thing is you will never be bored. You will be challenged every single second of every single day in this kind of a role, and that's a pretty cool thing to be able to say about your day job.
Absolutely.
So,
I think
do we have any other question that somebody wants to throw out there? We probably have time for one more question from the group.
right here.
It's interesting. What are the most important skills to succeed in this area, especially when you just want to enter into industry?
I would say, statistical modeling skills, programming skills, communication skills, as we've emphasized in the past, attention to detail.
Yeah, I agree with you. I think it's a big plus if you can communicate. That's one of the things that I see that really gives you an advantage, because then you can actually show what you, because if you do a quant strategy and it's the greatest strategy in the world, that's not going to work anymore. It has to be able to be explained to your investment committee, which also has to be explained to, an investor who maybe isn't a quant. And so the more that you can be a good communicator and a good programmer and good at the details.
Yeah, and I agree, and I would add to that, try to see the big picture. I see a lot of folks working on quantitative strategies that, are really focused on exactly what they're doing. They're a mile deep, but not very broad. And I think it's important to understand an investor's perspective. It's important to understand your firm's perspective and the strategy, as well as that whole teamwork, right? Yeah. The quants with the business people, with the discretionary people, with the data people. Having that really broad perspective, I think, is really helpful over the long run.
Yeah.
Time.
Thank you, ladies. Thank you very much.
Thank you.